Okay, welcome back everybody. Today we're covering section 17, which is managing an existing position. And we're trying to answer the age-old question, when do we exit a position? Remember, we're not your financial advisors, so we're not here to give you specific investment advice or recommendations, and any specific company that we do talk about in this section is to be taken as educational and illustrative purposes only. Here's a great quote by Benjamin Graham. The essence of investment management is the management of risks, not the management of returns. We have thrown a lot at you, and we're now getting towards the end. So far, you've learned how to find, analyze, and value potential businesses that you may invest in. You've also learned how to get it at the right price, even if it's not yet at the right price. And in the last chapter, you learn how to take the appropriate amount of risk on each investment. Before we end the course, you need to have this question answered. When do I sell? That's the million-dollar question that has baffled investors since the beginning of time. And you can ask 10 people this question, and you're probably going to get 10 different answers. But I'm going to teach you what I've been taught and how I go about selling a position every time I make a decision to sell. As Warren Buffett once said in his letter to shareholders back in 1996, don't think of yourself as merely owning a piece of paper whose price wiggles around daily and that is a candidate for sale when some economic or political news event makes you nervous. Instead, visualize yourself as a part owner of a business you expect to stay with indefinitely, much as you might if you owned a farm or an apartment house in partnership with members of your family. And according to the Oracle of Omaha, his ideal time to sell is never. And this applies to companies that are well run with great management teams in place. Because it's much easier to hold on to a great company that you've already identified than it is to go through the research process all over again and try to find the next great business to invest in. Once we identify a great company, we need to make sure it's continuing to be a great company. If not, we need to make some changes. As long as the company is great, it's continuing to maintain its moat, run by a great management team, and isn't terribly overpriced, we can keep it forever, just like Warren does. And here's another quote from the same letter to shareholders. We continue to make more money when snoring than when active. You simply want to acquire at a sensible price a business with excellent economics and able, honest management. Thereafter, you only need to monitor whether these qualities are being preserved. So what Warren Buffett's doing right here, his money is working hard for him, not like this guy right here is day trading every second the market's open. This guy's working for his money. He's not letting his money work for him. So please don't be like this guy. But what if the company starts to deteriorate? What if new management comes in and has a completely different view on how to run the company? What do we do when the moat has been breached? Here's my criteria for managing an investment while I own it and the criteria for selling an investment. But first, I want to talk to you about how I manage the stock while I own it before we talk about selling it. We did all the hard work in the beginning by reading a few years worth of 10Ks, reading articles about the company and the industry, and going through the 50 items on the checklist. Once we own the stock, we still need to do some work, but not nearly as much. In between the annual reports, which are the 10Ks, the company publishes a quarterly earnings report, also known as a 10Q, which is required by the SEC for any publicly traded company. Each quarter, the company tells us how the earnings and revenue increased or decreased since the last quarter and since the same quarter a year ago. And they also include management discussions, market risk disclosures, etc. It's basically a condensed version of the 10K. You have to read these, or you can also listen to them since recordings are available. And this will keep you up to date on everything you need to know about the company. Another thing I do to stay informed is to put the tickers of the companies I own on a watch list on the Seeking Alpha and the CNBC smartphone app. Anytime there's a news story on one of those companies, I get a text alert. This is a valuable tool to help me stay current on any news events in between quarterly reports. When the 10Qs come out, we need to do a few quick calculations to make sure that we're up to date on where the intrinsic value of the company is valued. We need to take the new financial data given in that report and adjust the valuation. Usually there won't be a huge difference, but on occasion there will be, and we need to know about that. The most important part about listening or reading the 10Q is to hear what management has to say about the company, the competitors, and if the company is improving its operations. If the reason we invested in the company has changed, we need to reevaluate whether or not we want to keep the company. We bought the company because it fit our criteria of a great business with great management, and it was at a discount price. We determined that the undervalued price was an opportunity created by a news event that caused a negative overreaction to the news. We know that we need to be patient and give the stock some time to revert back to its correct intrinsic value. However, at times, great companies become not so great companies. If we own a company that had a great story behind it, and we now realize that the great story is changing to a bad story, we need to get out. We may need to reevaluate whether we should hang in there or not if a CEO retires, and if it was a shareholder friendly CEO that we liked. We also need to reevaluate things if the current CEO becomes ill, if the CEO steps down, or if a new CEO steps in with a different view on how to run the business. If we bought a company that had a moat, but now that moat's been breached, then we may need to bail. If earnings are continuing to drop quarter after quarter, it's another reason why we might need to get out. If new government regulations are imposed that could hurt the business or the industry as a whole, we may need to sell. And a good example of this is what Obama did when he put the restrictions on the coal industry, which completely crushed that sector. Ideally, as Buffett said, we want to own a great company forever. But sometimes that may not be the best strategy for smaller investors like us. Warren Buffett has the ability to make corporate decisions, change management, etc. if a great company he owns starts to change, but we don't have that ability. Joel Greenblatt said that when we buy a great value stock at a discount, it could take 2 to 3 years for that company to turn things around and get the stock back up to where it should be valued. And remember, we're buying great companies that are temporarily out of favor. It could be out of favor because the business is having a short-term issue, the industry is out of favor, or the entire market is out of favor. When something is out of favor, it could have a quick turnaround, especially in a bull market. However, we need to be patient because it doesn't always turn around immediately. And Greenblatt gives his stocks 2 to 3 years to let the reversion to the mean take place. If it doesn't happen by then, he usually moves on from it. Another reason to consider selling is if the stock goes beyond its intrinsic value. If that happens, I will start to sell some of my shares. For example, if we determine the stock was valued at $100 a share, we can start to sell some of the shares once it goes above $100. Remember the reversion to the mean rule. Most of the time, a stock that is undervalued will revert back to its true value, but also most of the time when a stock that is overvalued will revert back to its true value. It's not going to stay overvalued forever. Once the stock gets back up to its true intrinsic value, it may stay near that price for quite some time because that's where it should be trading. If it goes above its intrinsic value, we should take some profits off the table while it's overvalued. There's a better chance that an overvalued stock comes back down to its true value than to continue to trade at overvalued prices. And once it's overvalued, you can use a few different strategies to sell. You can get out completely as soon as the stock goes 10% above the intrinsic value. If you do this, you lock in a profit. And as the old saying goes, nobody goes broke by taking a profit. After you sell, if the company's still a great company, put it on your watch list and buy it again when it goes back on sale. Another strategy that I like to use is to sell half the shares once it gets to my target price and then sell more shares when it reaches 10% above intrinsic value. Another strategy is if the stock is starting to lose steam and it goes flat for some time, move your money elsewhere, or you can also do a buy right combo. Take a look at the following chart on Under Armour. We bought it at a discount in 2013, and the stock did nothing but just took off for about 2 years with very few bumps in the road. In July 2015, after it soared past the intrinsic value, it started to trade flat for several months. Up here in the top right corner, you see the nice rise over a couple of years, and then finally it trades flat for a little bit and then starts a little bit of a decline. At that time, we decided the velocity of money was slowing. When a stock starts to lose its steam after a big rise up to and through the intrinsic value, we're going to sell. On this particular investment, we tripled our money, so at that time we sold out completely. 2 years later, it has yet to get back up to the price where we sold out. The next way to sell your shares once it goes above intrinsic value is to use a trailing stop loss. A trailing stop is an automatic order to sell a security if it moves in an unfavorable direction. Trailing stops automatically adjust to the current market price of a stock, providing the investor with greater flexibility to profit or limit a loss. The advantage of using a trailing stop loss is that if the stock continues to climb, even at overvalued prices, then you're still in a position capturing the extra gains. When we use stop losses, we will do so once the price gets above our intrinsic value price target. And we like to use a 5% stop loss. That means that if stock is at $100 a share, we're going to set a stop loss at 95. If the stock continues to climb, the stop loss will also continue to climb and will always be 5% below the price of the stock. However, if the stock starts to decline, the trailing stop loss does not move. As soon as the stock drops 5%, we are automatically sold out of the position. The benefit is that we can gain more upside if the momentum continues. Downside is that a stop loss does not prevent a gap down. And a gap down is a break between prices on a chart that occurs when the price of a stock makes a sharp move down with no trading occurring in between. And this usually happens after the market closes or before the market opens. Gaps can be created by factors such as regular selling pressure, earnings announcements, a change in an analyst's outlook, or any other type of news release. If a stock is at $100 and we have a stop loss at 95, we may not get sold out at the price of 95 that we're expecting. If a stock has a gap down in after hours trading or pre-market trading and the stock opens up at $88 a share, then we get out at that price, not the intended $95 price. Gaps are events that cannot be avoided. Your order will be entered once the price moves below 95, but this does not guarantee that you'll be taken out at a price near 95. If XYZ stock price gaps lower and opens at 88, your stop loss order will turn into a market order and your position will be closed out near 88 rather than 95 like you had hoped. Another interesting way to sell your shares and make more profit while doing so would be to sell short-term in-the-money covered calls. In case you forgot what we taught in section 11, a covered call pays us a premium for the obligation to sell our existing shares at a specific price by an expiration date that we choose. A strike price that's in the money means it is already at a price that would obligate us to sell. For example, if a stock was trading at $101 a share and we sold a covered call, and in the money strike price in this example would be a strike price at $100 a share or anything lower. Why would we obligate ourselves to sell our stock at a price below where it's currently trading at? Well, the reason is simple. The premium that we collect will pay us more money. That's why. Here's an example. Assume we own 100 shares of Starbucks, and we're also going to assume that it's overvalued right now. It's not, but just for this example, let's assume that it is. And the shares are currently trading at $56.71, and we want to sell because we made a very nice rate of return and it's overvalued. There are two reasons to sell an in-the-money covered call. The first is if we want to sell our shares, we're actually decreasing our chance of having to sell it if we select an out-of-the-money strike price. So second, by selecting an in-the-money strike price, we get paid $2.02 to sell the 55 strike expiring March 2017. It's only 11 days away. Or we can also collect $2.49 to sell the 55 strike that's expiring in April of 2017, which is 46 days away. If exercised, we're going to make more money because of the premiums collected compared to just selling the shares outright. So what we see here is a chart for Starbucks. You got the ticker symbol up here. Here's the March expiration. Here's the April expiration down here. And here's the mark at $2.02 and $2.49 at the $50 strike price, as you can see here all the way on the right. Instead of just submitting a market order to get out at 56.71, we would make an extra 31 cents profit by selling the current month expiration, so you have the $55 strike plus the $2 in premium minus what we would sell if we didn't do the option. It's going to create an extra 31 cents of profit. If we sold the April call, we would make an additional 70-cent profit. So keep in mind there's no recent good or bad news on Starbucks, so the option premium volatility right now is very low. Because there's not much volatility, this just means that we're not collecting as much by selling a call or a put. The benefit of this strategy is that we can earn more money while exiting a position. The risk is that the stock starts to decline and we do not get executed on the call option, meaning we're not forced to sell our stock. If the premium collected is high enough and may be worth that risk, you need to make that decision. And one way to minimize that risk is to sell shorter term expirations. The next way to exit a position, which is one of my preferred methods due to the reliability, is to sell when the stock is trading at a historically high price to earnings ratio. You have already learned one of the ways to value a company by looking at where their current price to earnings is compared to their historical price to earnings. So in the valuation section, we looked at Disney. Their 10-year average price to earnings was just about 16, and the 5-year was a little bit over 17 PE. In October, November 2015, the stock became so expensive and it traded at a price to earnings of 24. As you can see on the next slide, the last time Disney traded at a PE of 24 or higher was in 2003 when the price to earnings was 28. That valuation put Disney at a price higher than it's been in 12 years. Reversion to the mean is bound to happen. There's a much better chance the stock will go back down to where it should be valued than to continue to trade at insanely high valuations. Here is the current price to earnings for Disney. Take the stock price of $122.10 divided by the earnings, which are down here, gives you a current price to earnings of 24.9. If we come down here, when was the last time we saw it north of 24.9? We're in the teens, we're in the teens, we're in the teens, we're in the teens, and we go all the way 2003. That's when the price to earning on Disney was 28. Since they traded at such a high price to earnings, it was a very clear sign to sell. And what happened? The stock did revert back to their mean. It fell from $122 a share by November 2015 all the way down to $85 a share by January of 2016. Another great example of this is Target. So I bought shares of Target shortly after the data breach incident in December 2013. And we got in early 2014 around $60 a share, a little bit higher than 60. For most of the year, it didn't move, but going into the holiday shopping season at the end of 2014, the stock finally started to take off. Going into the first quarter of 2015, they hit a high of $80 a share. I recalculated the valuation numbers after the latest 10Q call, and Target was clearly overvalued. I looked at the current price to earnings, and I compared that to the historical price to earnings, as you can see on the next slide. What we see down here, these are 3 times where it's a very good time to buy the stock. Here are 3 terrible times to buy the stock, and we're right around here right now. The average historical price to earnings going all the way back to 2000 is 15. We bought the stock at a price to earnings much lower than that, and as of June 2015, it hit a new high of $80 a share. Stocks are rarely undervalued when they're setting all-time highs, so we got out, but we didn't get out because it was at an all-time high stock price. We sold because the price to earnings was at a historically high level, and remember what Buffett tells us, price and value are not the same thing. So we didn't get out because the price of the stock was high, we got out because the value was too high. Going back to 2005, Target hit a price earnings over 18 just 3 other times, and that was also a clear signal to sell the stock. And since we sold it, it fell to $64 in the following months. In February, March 2016, it got back up to 80 briefly, and it fell to a low of 64 again by May 2016. And in November, it rose back up to 76, and then it fell down to 56 in March 2017. So this is reversion to the mean at its finest. Each time it was undervalued, it climbed back up, and each time it got overvalued, it fell back down again, like clockwork. History can tell us a lot about what the future could hold, especially for a predictable company like a Disney and a Target. And history told us that the price when we sold wasn't sustainable. And history was right because Target fell back down after we sold it. Many of my sell decisions were based on this one strategy right here. One last reason I decided to sell would be declining margins and profit ratios after I own it. Part of the checklist is to make sure profit margins and performance ratios like return on assets, return on invested capital, and earnings yield, just to name a few, are improving each year or at least they're remaining constant. Sometimes these look great, but after we get into a position, they start to deteriorate. If that happens, you need to find out why. Is the moat falling apart? Did a change of management occur? And if so, did an incompetent team take over? If the answer is yes, and if the problem doesn't seem like it's a short-term issue, you may need to move on. The moral of the story is that we would like to hold on to a great company forever, but many times we shouldn't. We have shown you many ways to sell, but it all boils down to this. We sell when the story changes, the moat's been breached, we gave it ample time and it hasn't done anything, and it's reached our target price, and or it's overvalued. That's it for section 17. I'll see you over in 18 real soon. Take care.